am Asnath Ahmed and I welcome you all back to this sixth video series, and it is the fifth video of this series. And in this we will be talking about accounting cycle, and it will be the last video in the accounting cycle series. And in this we will talk about the reporting the financial results. So in this video we will talk from the financial statements, what are they towards the closing entries. So without any further ado, let's get to it. Moving on to our next slide, it is about preparing the financial statements. So financial statements are the integral to accounting process. They provide a comprehensive view of an organization's financial health and operational performance. So they summarize and organize the financial data that is collected throughout the accounting cycle, adhering to the framework such as generally accepted accounting principles, or IFRS, which is International Financial Reporting Standards. These principles maintain consistency in accounting throughout the world. IFRS is more of an international set of principles which most of the countries use, and GAAP is mostly in the United States. So there are three primary financial statements that we make after the accounting cycle. These are the income statement, then there is statement of retained earnings, and then there is a balance sheet. So the income statement details a company's revenues, expenses during a particular accounting period. They culminate the net income or net loss and tell us about whether it is a company is profiting or losing money. So it highlights the operational performance of an organization, and it indicates how efficiently its operations are being performed. So next statement we will make after the accounting cycle is the statement of retained earnings. So the statement of retained earnings tracks the changes in retained earnings over the reporting period. So it starts with the opening balance, adds the net income, subtracts any dividends paid, and ends with the retained earnings at the end of that particular period. So the next statement that we will be making after the accounting cycle is balance sheet. So the balance sheet is also known as the statement of financial position. It offers a snapshot into a company's assets, its liabilities, and its equity at a specific moment in time. So it demonstrates the financial structure and liquidity of the business. It showcases how resources are balanced or finalized in a particular accounting period. So this was this slide. Now let's move on to next slide. The next slide is about income statement essentials. The income statement, also known as the profit and loss statement, is a cornerstone of financial reporting. It provides a summary of a company's financial performance over a specific period, offering stakeholders insights into profitability and operational efficiency of an organization. So its key purposes are it analyzes the profitability. So the income statement identifies the organization's ability to generate profit. It helps the stakeholder evaluate the financial health of that organization. Then its purpose is the operational insights. It provides operational insights into an organization. It highlights the core and necessary business activities, revealing the effectiveness of resource allocation of an organization. So its structure and components include revenue, then there are the expenses, and finally there is net income. So revenue means that the income generated primarily through the operations of an organization, through its primary operations. Then there are expenses, which are costs that are incurred in generating those profits, and then there is net income or net loss, which is the bottom line result that is derived by subtracting total expenses from the total revenue. A positive net income will mean that company is profitable, whereas a negative will mean it is going in loss. So that was this slide, and we will move on to next slide. which is about the statement of retained earnings. So the statement of retained earnings provide a detailed account of changes in retained earnings over a given period of accounting period. Then the retained earnings represent the portion of the net income not distributed to shareholders as dividends, but it is reinvested into business to fuel growth and development. So what are its key components? First component is beginning retained earnings. So the balance carried forward from a previous accounting period is mentioned first. Then there comes the net income or net loss, which is derived from the income statement. It reflects the profits and losses during a particular period. Then we have the dividends that are paid to the stakeholders or shareholders in that period, and at the end we record the ending retained earnings, which we get at the end of the accounting cycle or accounting period. So what are the purposes of retained earnings? So its purpose is that it demonstrates the company's reinvestment strategy and commitment to growth. So it also highlights the balance between rewarding shareholders and strengthening the business, which one a company prefers or how it balances the both. So it also links the income statement to the balance sheet, ensuring the consistency across the financial statements. That was it from retained earnings slide, and now we will move on to our next slide, which is about the balance sheet breakdown. So the balance sheet or the statement of financial position is a snapshot of an organization's financial status at a specific point in time. It provides insight into a company's resources that are assets, its obligations, which are liabilities, and finally the owner's equity. What are its key components? Its key components are assets. Assets are resources that are owned by a company, and they are further categorized into current assets and long-term assets. Current assets are those which have lifespan of less than a year or equal to a year, and the long-term assets or fixed assets are which have lifespan of more than a year. Then the next component is the liabilities. So liabilities are basically the obligations of the company that it owes to outside parties. It is further classified into current liabilities and long-term liabilities. So current liabilities are the ones which have a duration of a year or less than a year, and the long-term liabilities or fixed liabilities, you can also call them, they have a duration of more than a year. Then there is the final component of balance sheet, which is equity, owner's equity. So it is the residual of the retained earnings, and it is also the capital that is invested into company by the owner. Talk about the purpose of balance sheet. What is the purpose of balance sheet? It evaluates the company's liquidity and solvency. It also highlights the financial structure and reliance on debt versus equity. It offers insights into resources allocation and company's management. Now let's move on to our next slide, which is about the closing the temporary accounts. So closing temporary accounts is the final step in the accounting cycle before preparing the after closing trial balance. Temporary accounts include revenues, expenses, and dividends, which are reset to zero at the end of the accounting period to prepare for the next cycle. This process ensures that only the current period's financial activities are reflected in the books or the accounts of a company. So what are the key steps in closing the temporary accounts? It is first is the close the revenue accounts, which transfer the revenue balances to income summary accounts. This consolidates all revenue figure into a single account for a particular period. Then closing the expenses account, transfer all the expenses balances to the income summary account, offering revenues to calculate net income or net loss. And similarly, we also close the income summary, and finally we close the dividend accounts. So the purpose is include it ensures that the temporary accounts begin the new accounting period with zero balances, and then reflects the account that impact the revenue, expenses, and dividends on the retained earnings. It shows the impact of them on retained earnings. So now let's move on to our next slide, which is about after closing trial balance. The after closing trial balance is prepared once all the temporary accounts are closed. The document lists all the remaining accounts in the ledger, which are exclusively permanent accounts, which may be assets, liabilities, equities, and etc. And its purpose is that the after closing trial balance confirms the correctness of closing entries, and it ensures that the books are balanced. It helps identify any errors that might have occurred during the closing process, such as incorrect transfers or missing entries. So let's move on to our next slide, which is about the notes to the financial statements. So the notes to the financial statements provide the additional context and detailed explanations to the figures that are reported in the financial statements. These disclose the description of all the accounts that were mentioned in all the financial statements that we have prepared. So its primary types are accounting policies. It also tells us about contingencies, and then a detailed breakdown of all of the financial statements, and then it also discusses the legal matters. So now let's move on to our next slide, which is about financial analysis and decision making. We use different type of financial ratios for our financial analysis. A few of them are mentioned here in this slide, which are current ratio, profit margin, and debt to equity ratio. So the current ratio tells us about measures of short-term liquidity. It is a profitability ratio which tells us how much of liquid cash a company holds at a particular point in time. And then we have profit margin, which indicates the operational efficiency, how much profitable an organization is. And then the debt to equity, which tells us about how much debt a company is in and how much it is maintaining the owner's equity or shareholders' equity. So let's move on to our next slide. We will be talking about concluding the accounting cycle. We will conclude it. And so first of all, what does it provide for our business? It provides the accuracy. It ensures that the financial reporting is accurate and does not rely on any guesses or other. It does not rely on making something else to look into an organization's financial position. Then we have a preparation of different types of financial reports or financial statements, and prepares us for the next accounting period. Then there is transparency, which we build trust through being honest to our shareholders and to our other stakeholders, and letting them know how our organization is performing. And finally, there is compliance. We comply with the law and see to it that the regulatory bodies are satisfied and there are no legal issues, and our business keeps on running in a safe way. That was it from this discussion. I will see you next video.